Well, thank you guys so much for coming this evening. I'm wearing this thing in my ear because there's a lot of out-of-state investors who wanted me to record this so they can listen in. So this will get emailed out. So even if you guys want to listen to this again, as far as a reference point, I'll email that all out to everyone. If you're not on our mailer list, we'll get you on there this evening where we send out deals, some podcast episodes I put out, anything you guys are looking for, I'm willing to put out there for you. I'm with Victory Capital Group, so that is my partner and I's syndication firm, who is Dante Belmonte. So this is my real estate office. I'm part of Hunt Real Estate, is what I hold my license with. I am 22 years old, so I'm on the younger side, but I'm really taking action, jumping in. We have moved over into the syndication realm, so larger apartment buildings. I host the Make Money Make Sense podcast. You can find it on Spotify, Apple Music. It's going to be everywhere out on there. So what I'm going to talk about tonight is syndications. I'm sure all of you guys have heard about it. You've heard some good things, some bad things. Hopefully I'll answer those questions. I'm not here to pitch or sell you anything. I'm here to educate you guys. If you would like to invest with us and that's something you want to do, that's great. We'd love to have you. If not, I hope you guys can take some education away from this. I hope you can network with someone else in the room that can help you out, whether it's a property manager, a contractor, a lender, or anyone in this industry that can assist you in some way. That's why I like to have everyone go around the room, introduce yourself, because maybe you pinpointed someone you want to approach after this, talk to, and touch base with them. So we're going to jump right in. Like I said, I'm going to try to get you guys out of here early because of the presidential debate. What is a syndication? So this isn't syndication as if you look it up online, this is what you get. This is my definition. So this is the pooling of capital from multiple sophisticated and accredited investors. We'll go over what those are. They'll be used for the acquisition of an asset such as apartment community to execute the project's business plan. And I'll talk about the business plan with that and everything that kind of breaks this down to make it a little simpler for you. I do encourage you guys to ask questions throughout. That's kind of how I thrive off of all of this. I'd like to hear what you guys have to say. I'd like to educate you a little bit more. And even if you hear me say something and you completely agree with it, I'd still like to hear from you and fact check me on everything. So first off, a syndication, pulling the money together of investors to buy, we'll say, an apartment community, because that's typically what it is. You could syndicate a Kit Kat bar, but I doubt you can get anyone to invest in that because the return's not very good. So you have accredited investors and sophisticated investors. So accredited investors here, as you can see, there's a few things you can do to qualify as an accredited investor. You have $1 million net worth or more outside of the equity or the in your primary residence, or you make $200,000 filing single for the last 2 years and moving forward, or married joint filing for $300,000 per year the last 2 years and moving forward. So that's the definition of an accredited investor. And I'm going to get into why I'm going over accredited and sophisticated and what the differences is. Sophisticated investor, this is basically me vetting you as a sophisticated investor. So you and I, we're going to have like a little chat, and I'm going to see what you're looking to do as far as investing goes, what risks you're looking to take on, what you're trying to accomplish, what returns you're looking to gather. And that will let me gauge if you're good for us or not, and if you are sophisticated in any means. What's the difference? So with syndications, obviously you're probably like, well, I don't hear about syndications that often because they're not advertised on billboards. I don't get Facebook ads for them like I do everything else that I'm interested in. That's because there's two different exemptions. So with a syndication, it is a security. As you can see here, is a security is a note, stock, treasury, stock, bond, any profit sharing agreement or investment contract that you can have. So that's what's going to be a security. So therefore, investing in a syndication and a passive route is a security, just like a stock. Everyone knows what a stock is. That's probably the easiest way to understand what a security is. When you're doing apartment syndications, you're raising capital and it's 100% a passive role for those passive investors. There's different regulations you have to go by. So there's Regulation D, exemption 506B Bravo, and 506C Charlie. 506B is the one you're not going to hear about because sophisticated investors can invest in that, and we can't advertise that at public. I'm going to get into a little bit more detail on what all of that is. 506C, that's the one you can hear more about because you have to be an accredited investor. I can put that on a billboard, Facebook ads. I can email blast everyone that I know I'm raising capital for an apartment community, but it's a 506C registration. So therefore, if you have $1 million net worth or you have the 200, 300K filing joint, you meet those requirements, you can invest with me. But if you do not meet those accredited investor requirements, you cannot invest with a syndication, not just myself or anyone that does a syndication. 506B. So like I said, advertising is prohibited. Rule 506B allows an issuer of its own securities to raise an unlimited amount of capital. So there's no cap on the capital you can raise. There's not a limited amount of accredited investors, but you can only take up to 35 non-accredited investors. So again, if your net worth is not $1 million or higher, that 200, 300 gross annual income, you're not accredited. Yes. So there's a few different ways you can do it. You can do it through the investor CPA. They can give you a letter. Their attorney, they can give you a letter. Or there's a form and a website you can go on and they can actually fill out a form, and that will let them know if they're accredited or not. So that's one that they fill out. Yep. So it depends. Right. So it depends on which one they're going for. If they're going for the $1 million net worth, bank statements, investments, don't even think about putting your primary residence in there because it doesn't count towards it. Or if they're doing the 200, 300K, they're going to be submitting tax returns for the past 2+ years so they can see that and verify that. There's companies out there that actually do that for us at a small fee. So we put all this information to them and they tell us that that person is now accredited or not. So is it either or, like you either make 200,000 or you are correct. Yep. So you could make over 200,000 a year and you can only have $800,000 net worth, therefore you qualify, or you have $1 million or higher net worth and you don't have that income. What the SEC, the Security Exchange Commission, recently added was there's a certain certification you can have to now meet that accredited investor standpoint. I'm not going to go over it because it's a little bit newer. I'm still catching up on what the licensing is you need for that. So basically with 506B, again, you cannot advertise. So that's why you're not going to see these deals out there. You need to know someone that's going to send you these deals. Hey, call you up. Hey, Rob, I have this awesome deal. I'd like to, this investment opportunity I'd like you to talk about with you. And we're going to go over all that. So a lot of times, the last few months, I've actually traveled around the country a little bit to talk about this stuff to different investors. And a lot of people say, okay, I want to invest with you. Well, we have to go through the steps together. And that is like down here. So first thing I'm going to do, it's like you're trying to pursue someone that you're looking to have a very serious relationship up to marriage. You ask for their number. That's the first thing. So I'm going to meet someone. Awesome. Let's exchange contact information. Okay. And let's start to chat a little bit more. That's where you officially meet them. You're out, you see someone that's good looking. Hey, I'd like to grab your number. That's the first step. Then it's time to go on the date. You text them. Hey, you want to get together? You want to go get coffee, something like that? I'm going to do the same thing with an investor. I'm going to take you out to dinner. I'm going to take you to lunch. I'm going to take you to coffee. And we're going to talk a little bit more on what your risk tolerance is, what you're looking to accomplish as far as returns and what that timeline is and what kind of capital you have to play around with this. Then we get engaged. So now I'm going to start sending them the paperwork for the properties that I might have them invest in, that they're interested in. This is all through the SEC regulations. So this isn't me picking that I want to do this stuff. As much as I do want to get to know investors, it's what is required by me by law. Then we get married. So that's when they send over the money, we start investing, and the deal goes underway. So that's going to be the 506B. 506C, or excuse me, a summary of 506B, you can raise an unlimited amount of capital. So again, we don't have any cap to what we can raise. We can have an unlimited amount of accredited investors. So again, that $1 million net worth, 200, 300 that you make per year, I can have unlimited amount of that, but I can only have 35 non-accredited investors. So if you don't meet that accredited investor standpoint, I can't have you. Or I can only have 35 of you. So all the investors are obviously going to be sophisticated because they're either accredited or sophisticated, and we cannot advertise to the general public. 506C, so again, what I kind of talked about is we can't advertise to the public. We can advertise to the public with 506C. You have to be an accredited investor. So the reason why the SEC lets us do this is because typically the people that have $1 million net worth or more, or make 200,000 to 300,000 per year, typically they know what they're doing. You don't just fall in a position, not know finances too well, and get this accredited investor standpoint. Does this make sense so far to everyone? Does anyone have any questions? I know I'm kind of going quick. Like I said, I want to get you guys out of here this evening. So again, issuer, we could still raise an unlimited amount of capital. They're going to come from an unlimited amount of accredited investors. So I'm not capped out on how many investors I can have. The advertising of the offering is allowed and investors must be accredited. This is going to be how we break down the syndication structure, the ownership structure of the asset. So starting over here, let's say we buy a 100-unit building that's 123 Main Street. So for every property we acquire, every asset we acquire, it's going to go in its own entity. That entity is going to hold title to the building. It's also going to be the borrower on the loan. So if I go over to Empower and I say, hey, Nick, we're going to get a loan. We're creating a new entity. And Nick, you can correct me if I'm wrong on this. People say, okay, well, you just created a new entity. You don't have any history. How can you go get financing for $3 million? Well, Nick's going to say, okay, let's look at your past buildings, what you've done recently, send me some rent rolls, send me some P&Ls from past years, and they're also going to look at the guarantee on the loan. So that's how we're able to do that. I had someone ask me that question. Yes. P&L, so that's profit and loss statement. So what that's going to, or a T12, trailing 12. So what that's going to do is for every property you look at and every property you're buying that's typically a larger multifamily scale, it's going to have a profit and loss statement for the last 12 months. So it's going to tell you, you're going to have at the top, and I have an example one up in here I'm going to show you, but it's going to have your rents, your loss to leases, bad debt, all going to break down, then your bigger expenses, and it's going to show you basically what the profit nets at the end of the year. It's a great question though. Yes. There's going to be two structures. So the second structure might answer your question for that. And we'll go over the preferred return. But you're saying that they get paid back the initial cash flow first, and then it goes to the investors? I'm sorry, I don't understand the question.
So say you have a limited partner, they put $1 million
yep.
in your deal, and they have 8%.
Preferred return, yep.
Right, so they need to make $8,000 a year.
Before anyone else gets their distribution.
Right, so do you, the way that, I've seen it both ways, I'm just curious. Do you, say $100,000 comes in the door.
Yep, they get the 80 first.
They get their 80 first.
Yep. But
you still are going to get a cut of it because obviously they haven't paid back their $1 million yet. You haven't refinanced, you haven't sold yet.
So I'll get into a preferred return, but typically how we see them structured is it's preferred return in the first year. So it's non-compounding. So after they get their 80%, that additional income is split to 70-30.
You don't need to have their equity out yet, right?
Correct.
It's just the interest-free portion of it.
Right, correct. Yep, exactly. And if you still have that question as I go through, please ask. I want to make sure I make it clear to you.
No, I understand it all very well. It's more like I'm just trying to understand what the market is. Less than trying to understand what it is. I'm saying what's sort of the market, because a lot of what I've seen.
Like what this current market is offering is what you're saying?
Like a lot of what I've seen is more like you only get a split once your LP has paid back all of their investment in a refinance.
Yep, each investment's going to be.
And then you can start getting your cut.
Well, a buddy of mine doesn't even do a preferred return. He also doesn't do an acquisition fee. So that way they're not paying acquisition up front. He's not getting $400K. He's not paying ordinary income on that. And therefore the returns are higher and the raise is less. And again, I can get into that a little bit more as we go on, but great question. So again, LLC, title holding, borrowing entity. Then you have us over here as Victory Capital Group. So that is known as the general partner, the GP, the sponsor, the issuer. And then the limited partners are the LPs, the passive investors. So those are the guys that are, writing us the check for their passive investment. They're typically going to see about 70% ownership. We're going to have about 30% ownership of the asset. So obviously these guys are going to have the higher amount of ownership because they're taking on a majority of the risk. They're investing the capital. The way we make our money over here is off of fees and a small amount of splits and proceeds at sales. So you'll see acquisition fee. So basically when you start the project with us, there's about a 1% to 2%, depending on the size of the deal, acquisition fee. And that's where we make some of the income up front. A refinance fee. So if we're refinancing the property at some point in the business plan, typically in that 3 to 5 year range, we'll get a percentage of that. Disposition fee, exactly what it sounds like. When you sell the property, you dispose of it. There's a fee to be paid there. Not really like a commission, but it can be seen as a commission. Split of quarterly profits. We're looking more towards monthly profits and then proceeds from sale. And their limited partners are going to get the priority split of quarterly profits or the proceeds from sale, or they will see a part of their capital back on the refinance of the property. Does this make sense to everyone so far, how that split works? Any questions on that? Yes. So the GP typically is not putting up any capital. If we're putting up capital, which is typically $100,000 each, my partner and I, we're buying part of that 70% split. Yep, yeah, exactly.
That's what I thought.
Yep.
So in this case, you're right, when you put up 0, you're getting 30%.
Yep, this is more the ownership breakdown of where the equity is, the refinance. What you'll see a lot is the sponsors, the GP, are not investing in some of these deals. They're trying to go in with a zero down deal. And it doesn't really align the interests. So what I'm personally doing, what my partner's personally doing, so a little bit background, my partner, he's in Charlotte, North Carolina, chemical engineer. He built some plants for Tesla, very, engineer minded, very talented individual. He's sold off all of his assets. I'm in the process of selling off all of my smaller assets so we can invest with these guys over here. We're showing skin in the game, alignment of interest. I'm sure the bank likes to see that as well. And so we're looking to put up, if it's a minimum of $25,000 or $50,000 investment for our limited investors, we want to double or triple or make that quadruple. We want to show them we've got skin in the game. If we're going to care for our money, we're going to care for your money, kind of thing. And plus that, I want to get the returns on this side as well as that side too. It's pretty sweet. A second way you're going to see a syndication deal structured is going to be like you see here. So this is more of a tax stand purpose, but now you're going to have two splits here. So you still have your 70% with your passive investors, but now Victory Capital Group, us, we typically don't own anything in this asset. Just the managers of this asset own part of this asset. So I know it's kind of confusing. That's why I tried doing a visual graph to make it a little less confusing. So let's say we have 5 general partners here. So myself and 4 other individuals that are putting the deal together, writing up the business plan, asset managers, all that good stuff. We might actually only have 2 of these 5 guys as asset managers. So therefore they're now involved a little bit more in this entity. And sometimes some CPAs will want to see it structured like this just for a tax perspective. So this entity over here, they're going to get the acquisition fee, the refinance fee, the disposition fee, but then these guys are going to get their split of proceeds on the sale, the quarterly or monthly cash flow as well, which I'll go into a little bit more of that. Does that still make sense with everyone? I know it's getting a little confusing there. So these are important performance indicators to know. So when you're looking at smaller multifamilies, you're probably looking at cash on cash return and cap rate, which are still great metrics. Cap rate is what you'd be looking at if you bought the property with no debt. And then cash on cash return is basically your return on your investment in the property. And then equity multiple. So these guys, cap rate still matters, but it's more of a purchase and sale portion. But you're going to have IRR, cash on cash return, and equity multiple. I'm going to get into those two, what those mean. So IRR is going to be the most confusing one out of all of them. You can't really calculate this on a calculator. You do need a spreadsheet. So what the IRR tells you, it's not the annual rate of return. It's how much the annual growth of your investment has. So typically in year 0, this is going to be how much is invested. So let's say in a deal you have $1 million invested. Year 1, you've got $60,000 in cash flow. Year 2, 80, 90, 100. And then in year 5, because let's say it's a 5-year business plan, there's a $1.5 million distribution. So this is proceeds from the sale, and it's going to be cash flow from that year. So that's going to show your money's growing at 14% per year. So that's calculating the time value of money and what your investment is doing over those 5 years. Again, it's a little more confusing because I can't show you a formula, but the simplest way to put it is it's just showing how much your money grows annually. Does that make sense with everyone so far? Okay. It's just a little visually easier to show your investment. Cash on cash return, everyone's probably familiar with that. So let's say you received $10,000 of cash flow, you invested $100,000, you have a 10% return or a 10% cash on cash return with your investment. Going back to IRR, you'll see anywhere from about 10 to 20% in IRR in apartment buildings. If you're getting towards that 20% or higher, it's pretty questionable because either it's a large return because there's a large amount of risk, or you have an operator, an issuer, or a GP who has no idea what they're doing and they're not being conservative on their numbers at all. Cash on cash return, 8 to 20% is something you'll see as well for the cash on cash return. Again, higher number, more risk, more reward, unless you found a banging deal. Equity multiple. So the best way I like to go about this one is it's kind of like you go to Vegas. You say you go with $100,000, you turn your $100,000 into $150,000. You 1.5x your money. That's the best way to understand that. So if I went to Vegas and I brought, I doubled my money, it's because I brought $100,000 to Vegas. I left with $200,000, so I doubled my money. That's 2x. So the equity multiple, you can read the definition here. I try not to read off the slide so I don't sound like a robot. That is going to be what has happened to your money over that 5-year business plan. So you'll see typically 1.5 to 2.5 on an equity multiple over the business plan for a syndication. So 1.5, like I said here, 1.5 times your money. 2.5, you doubled it plus a little bit more for your investment. I mean, obviously it's pretty sweet to have your money within 5 years double. It's a nice investment. What we're looking for in a property. So us as a group, I'm going to come stand back here because I'm actually going to read that because there's a lot of points. We're looking for must cash flow from day one. So as we have investors with us, we want the property to cash flow because as investors, you guys want cash flow. And that's sometimes we'll take advantage of a 12-month interest-only loan because if the property needs a little bit of work, the rents are low, or we're putting some money into it. To get cash flow, we're going to bring down that debt a little bit more by taking on interest only. We're looking for below market rents. So that way there's a value add perception to that. So if rents are $900 a door and maybe they're supposed to be renting at $1,000 or $1,100 a door, we can implement those raises. Manageable amount of deferred maintenance. So obviously we're not looking to go into something with a lot of risk that has foundation issues, major roof issues, major HVAC and the whole 9 yards. 20 to 100 units. The reason why we look at 20 to 100 units, because 20 and below, there's typically a lower barrier to entry. So there's a decent amount of competition there. 100 plus, now you're starting to compete with a lot of the bigger boys. You know, we're not very big. I'm not going to sit here and tell you I'm more financially inclined or more stable than any of you guys here. So we want to compete with people of our stature. So if we're doing that, REITs are going to be looking at more of 100 units and higher, usually much higher, but some of them will step in at that point. So that 20 to 100 units, we can stay at a more manageable standpoint. We're not competing with as many people. Sometimes we are, depends on the markets we're looking at. B class and C class areas. We're not looking at A class areas because straightforward, we can't afford them. And 2, A class is going to be that higher end apartments. If there's an economic downturn, people that are trying to save money are typically going from A class down to B class, down to C class. They're falling through. Or C class, not D class, excuse me. We don't want to be in D class because that's a lot of Section 8, lower income housing. It's just not the tenant base we want to get into. It's older. There's more maintenance issues. The tenant base isn't the best. It's more of a challenge and it's more management heavy. So that's B class, C class. Typically, if we could find a C class in a B class, that's a good move for us. Yes. Yeah, exactly. I mean, I've sold D class properties for 40% cap rates. I mean, that's a thing, but good luck getting the tenants to pay most likely, and you've probably got some big issues. Correct. It's Catholic Charities, right? Yep. See, that's nice. Right. In cases like that, it does work, most definitely. You got a pretty sweet deal set up with Catholic Charities. I know that. Exactly. Yeah. If you have an out-of-state investor who's doing D class and they just threw the keys to property management, odds are it's not going to look too hot. But someone with you that's local, knows the knowledge, knows how to make these things happen, you're going to do a lot better. Yeah. And something that we're seeing with this B class area, C plus area, is you typically have young professionals or tenants who do have something to lose. They have a credit score they don't want wrecked. They do want to be in a nice place. So therefore they're not going to ruin the opportunity they have at hand. And that's why we kind of like that area. Like you said as well, if you're right above, that threshold, they're just trying to hold on. They barely meet the income requirement for a unit. Yes. Yes and no. So it's going to vary by market. So a C class here is going to be very different than a C class down in North Carolina. So a lot of times these classes are defined by age of the structure. So up here, our structures are 100 plus years old, 120, 130 years old. We're down in, the Carolinas, the oldest structure they have here may be 50 years old. So their C class could be 1970 or 80 build versus our C class could be a 1950 build. But I totally get what you're saying with the tenant base as well. And that's why a very important management team just makes more sense as well in that. But that's a great point. Yes. Well, I know the market's terrible. Right. And plus that, if you're looking at assessed value from a tax standpoint, our taxes are higher, therefore our properties are lower. Their taxes are lower, so therefore their properties are higher. You go down south and you see a 3-bedroom, 1-bath house for $500,000. You're like, what in the world? I can live lavishly in central New York for that, versus we pay $150,000 for that. So does that answer your question a little bit? Okay. Yeah. Pitch roofs, the reason why we look at this a little bit, Freddie and Fannie Mac sometimes will not lend on or on flat roofs. They want pitch roofs. And, you know, that's very obvious of why. A pitch roof's going to last much longer. It's got water running off it. And if it has a steeper pitch versus a flatter pitch, you're not going to have water sitting on there more, or just anything sitting on there more. Built after, or value add aspect, we're looking to add value to the asset. You know, you make your money when you buy. It's very true. And we're looking to implement more income to the property and be able to capitalize on that, refinance, and be able to give some capital or all capital back to the investors. Built after 1978, lead paint. That's a big one we don't want to deal with. You got lath and plaster walls. You've got different kinds of plumbing, asbestos. With those older builds come older issues, more deferred maintenance. It's going to get more expensive. It's got to be a bang-in deal to be underneath that. Possible land for self-storage. So we want area and room to expand and develop more. So we want some land near the property. My partner and I, we focus on multifamily. A self-storage deal came across our desk. There's like 162 units locally. We're like, oh, this is pretty cool. And we ran the numbers on it. We visited the property. It was 35% occupied, or sub 35%. It's 5 years old. It was very, very unstable. We kind of put the brakes on the multifamily thing and said, hey, if we can make a good deal on this, let's make it happen. You know, we gave them 2 offers, which I thought was pretty cool. The 2 options we gave them. We gave them an offer for $1 million, and we gave him an offer for $800,000 with a 25% equity play for him. So we approached it as, okay, so you bought the land for $45,000 5 years ago. You put X amount, 100,000 into it to develop it. Where's your cost basis? So what we're thinking there is whatever he sells it at versus what he's all into it at, he's going to have a huge capital gains tax bill at the end of the day he's going to have to pay. And if we bought it at more of like $1 million, that property is only assessed at $500,000. The taxes are almost going to get double that assessment, and he's going to have more of a tax bill on his end, and then we would have a tax issue on our end because the property is assessed for more. We have to pay more taxes. So we said, okay, we'll do $800,000 with a 25% equity play for you. We'll give you 25% of the cash flow. We'll give you 25% of the sales proceeds. And we were looking at our assumptions and where we were with the math, and it made sense that we could give him 25%. He didn't have to invest a dime. The issue was he had another partner and they were splitting up, and he was moving down south. He said, okay, I'm going to Florida. I'm building an RV park. I'll take a little bit, a couple $100,000 of capital up front, and you can send me a check every month, every quarter, or annually. And then when you sell the property in 5 years at the end of the business plan, I'll take another check for a few $100,000. The problem was his partner wanted all the capital now. He wanted out and he wanted to go. He wasn't in a position to buy him out. And a much larger company came in and bid $300,000 over us. They want to buy the lower returns. Ding, 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 you have a winner. But self-storage, that's a great opportunity for us as well, because even if there's oversaturated in the marketplace for self-storage, because you can put these things up in less than a year, someone's going to store their stuff on their apartment community where they live versus 5 minutes down the street where their stuff is not. They can have eyes on, they have easier access, and maybe we can charge a little bit of a premium for that while they're there. If we're looking to do self-storage, we're going to go around, talk to all the tenants, see what the demand is there. If there's no demand for it, we're not going to supply it. And typically whatever we're going to do, we want to see at least a 25% return on it when we're building something like that. What can we do to improve the NOI, which increases the cash flow and the property value? So these are all things we implement on the property to increase the value of it. Exterior renovation. So, you're not just looking at the building itself, you're also looking at the parking lot, the landscaping, curb appeal. We're going to rebrand the property. So we want people to know that if there is bad management in place or a bad owner before, that there's a new owner, new management, new attitude, and we're going to make things a little bit better. Interior upgrades, cabinets, countertops. You guys all know it's doing renovation. This is what you're going to see. But we're also implementing, I think I have that down there on the list, so I'll go over that in a second. We're going to align rents with market. So obviously we do heavy market research beforehand. So that way we don't go into a business plan thinking we can get 1,100 per unit when the market's only in demand for 900 a unit. 200 a unit, that's a big spread that we missed out on if we didn't do our research right. As leases expire, we're going to move out the late tenants, the non-paying tenants, or just the crabby tenants that don't make it feel like the community. New management on the property, they'll be better. Add streams of income, like I said, storage, premium parking, coin op, laundry, maybe dog parks. And again, it's depending on geographically where you are. CapEx improvements, decrease expenses. So for contractors, we're going to get multiple new bids. Expenses come with water, so low flow toilets, low flow shower heads, better lighting on the property, and then the RUBS, ratio utility billing system. So we're going to bill back some of those expenses that aren't in the tenant's name possibly. So here's what the business plan looks like for us when we're implementing this process. We're going to analyze the market. So we're constantly looking at markets. We're looking for job growth, income growth, median home price increase, all of that. So we're going to research those emerging or secondary, tertiary markets. We're going to leverage local relationships. So obviously, when we're going into markets that we like, we want to have relationships built with people there, lenders, contractors, property maintenance. Then we underwrite the asset with conservative projections. So whatever the vacancy rate is at now, maybe we're going to bump that up 2 or 3 whole points just to be more conservative in that market. We're going to look at the competition, who's across town, who's across the street, who's next to us, and what are they renting for, and what can we do better. Then we get to due diligence. So let's say we do get a property under contract. Now we're doing the physical property inspection, file audits. So we're looking at leases, rent rolls. In the background, depending on what state you're in, our attorney's looking at the survey, the title, all that good stuff, getting that ready for closing, and other inspections we have on the property. Pre-closing, so now we're making the title holding entity. Remember that big one up here in the graph? That one's getting produced at that time because now we know what the asset is. Legal overview, our SEC attorney, because we are a security. We have a securities attorney filing up all these documents, getting the PPM, the operating agreement, the subscription agreement ready for our investors, and we're onboarding property management. One day we would like to get in-house property management if we have a lot of units in one area, so we can kind of save on that cost. Asset management, so now we're going to implement the business plan we built, what we're doing to units to renovate them, when we're doing that, how much we're increasing them by, what are we doing to the property, are we simply putting it online? Yes. About 15 to 25,000. The first one's the most expensive because you're structuring everything. After that, it's plug and play. So we just change out the property address, we change out the returns, all that good stuff. But the first one's gonna be more towards 25,000, and then it's gonna go down. Yes. Oh yeah, because you have a lot of people that may not know what they're doing as much. Not a lot, but your SEC attorney is involved more. It costs more to do a 506B than it does a 506C. Ballpark, depending on the size of the deal, maybe like 5,000 more. That's what you got your attorney for. She's doing everything on that sideline. The SEC will come in for like an audit, maybe down the road, but they're not sitting right there outside your office door checking over everything. You just, because like I said, it's a little more expensive to do. And if you don't have $1 million net worth or higher, or you make less than the 200,000 or 300,000, you're typically a little more pesty. What's going on with my money? What's going on with my capital? There's investors there they don't want to deal with, where if they can just do a 506C, it's going to be easier for them because they can advertise it and blast it out. So it's easier on their part to raise the capital, and you're not going to have such pesky investors. Not to say, I'm not saying anyone that doesn't make $1 million or more or have $1 million more net worth is pesky, but I'm just saying at that standpoint, when you have that amount of income, you tend to care less about what happens to that lower amount of income you're investing. Or if you've been investing with that syndicator multiple times, you just don't mind. So you'll see a lot of syndicators like ourselves starting with 506B because it's really, hey, grandma, you want to invest with us kind of thing, something like that, versus, okay, we know 100 really wealthy individuals, young professionals, professionals in the world that want to invest with us, and it's a little bit easier to manage. Does that answer the question for you in that? Silent partners are the limited partners. So they really have no say in just about anything. If there's an issue where you have a GP who's really corrupt and they're finding that there's some issues, there's some money being taken away, then that's when the SEC is even going to step in and say, hey, what's going on here? But they know what they're getting into. In the PPM, it's all going to state that they really don't have any voting rights. In some cases, they do. I know some people structure it in different forms where the limited partners want to have rights in the deal. They want to understand what's going on, and that's going to be all listed in the PPM for them. Does that sound good? Yeah. Okay. Asset management, again, what we're doing to bring up the value of the property, how we're bringing the returns that we're projecting to our investors, and then exit plan, like you were saying. We feel like the market's at a high value right now. We want to get out while we're ahead. We're at the top of the market. We want to sell that asset for top dollar value, and we want to distribute the funds to everyone. Yes. Mm-hmm. It's probably the most important one.
So
Not as soon as possible because we don't want to overwhelm ourselves, but a lot of these larger syndicators, instead of paying the 2 to 10%, whatever unit count it is, what they're paying for property management, they like to bring that in-house because they have a little bit more control. They know exactly who they have working. And again, like I said, more control. Not that you don't have control and you can't see the day-to-day with outside property management, but it's simple. I mean, if you could control some, I'm sorry? Yeah, most definitely. I mean, a good property management company is trained to take care of that already. But again, it's just, we can save on costs for property management in-house, therefore increase our returns. And if we're not outputting as much,
So it's just sort of cash, basically.
a little bit, yeah, it's going to balance the property all around. Yes. Monthly for sure, because, and we're getting towards monthly distributions because it's like this. Would you rather get paid 4 times a year or 12 times a year? You know, so that's why we're doing, it is, but if we don't have a bunch of investors and we have people, virtual assistants, let's say, that are taking care of it in the background, it's not as much for us. And we're seeing a P&L every month. So we can basically just kind of forward that off to them in a much prettier standpoint of how that looks in an email. But if you gave me $100,000, do you want to hear from me 4 times a year or 12 times a year? Yeah, exactly. You know what I mean? So, right. So typically these people that are investing with us, they want to hear from us more often. We want to have a more personal relationship with them. So we're going to look at that monthly standpoint versus the quarterly. I mean, maybe we'll give some really hefty quarterly numbers that look a little bit more in depth. But the monthly, I mean, we know what we're going to, by the 15th, we already know where we're going to be at rents and things like that. You're okay. Mhm. Yeah, they're investing passively as an investment. They don't want any part of that. Correct. Yeah, we're sign on the dotted line. Oh yeah, 100%. Yeah, I mean, especially if we're putting $100,000 on the LP side each, we're also eating up a large portion of that investment standpoint. So right away, we own like 10 to 15% of the deal ourselves. So they're going to want to see us on there plus the 30%. Yep. So my favorite book out there right now is called The Hands-Off Investor. Bigger Pockets sells it. It's not a very popular book in their lineup, but it basically is a book written to passive investors of how to invest with investors like ourselves. This is taken directly from, this guy's dying on me, so I'm just going to switch headphones real quick. This is taken directly from the Bigger Pockets book. Gentleman in the corner, you were asking earlier about a P&L statement. This is kind of what a section of it looks like. So it's chopped up as you're going to notice it throughout. Year 1, gross potential income, loss to lease. So this number up here is going to be if we have 100% occupancy on the property and everything's leased at market rate. Loss to lease is if it's not at market rate, how much we're losing there. Your vacancy, if the units are vacant. Concessions, hey, first month's free if you move in this month. That's going to be accounted there as well. Bad debt, people that aren't paying, and then units that are just not usable at the moment. That's your net rental income. That utility reimbursement, water, sewer, that's what you're going to see here. So this is your expenses, everything we're looking at here. So if you're getting reimbursed for waters through the RUBS program, you're going to see a reimbursement there. Pest control, we're not going to see that as much in the northern region. Trash reimbursement, miscellaneous income. So if we have storage units on the property, how much that's bringing in. Other income is the total of these guys. So these two numbers together is going to make 1.8 million for that year. Year 2, you're going to see it's going to start to increase as our rent starts to increase, our bad debt starts to decrease. Our expenses start to go down. Our loss to lease, because obviously we're leasing these units at market value now. We're not under market value, and moving on, so forth. So I kind of break down over here. 3-year rent growth year over year is kind of what we try to aim for. Other income, so like self-storage, we look at for a 2% annual income growth. Kind of went over what loss to lease is, all that good stuff there. So moving down on the spectrum, now we're looking at expenses. Property management, property taxes, insurance, repairs, admin, marketing, the whole 9 yards that gets us to our net operating income. You're going to see again that jump in net operating income is because now as we go and implement our business plan, those things are going to change. Property management, 3% effective growth incomes. I think this formula was based off of 100 units, I think. So that's why you're going to see that property management fee so low. You're like, I'm getting quoted 8 and 10% around here. Well, yeah, because that's they're managing a duplex that only makes $20,000 a year, not something that makes. And to kind of answer what you're saying, a lot of these good property managers are at capacity. So maybe we need to bring it in-house so we can get it taken care of, because these guys that are doing a killer job at property management and they're at full capacity, they don't have any more employees, they're maxed out on units. That's going to be maybe why we want to do in-house. Well, I mean, you need a real estate license. In New York State, you need a real estate license to manage someone else's property. If it's your own property, I mean, go for it. I always tell people, if you're starting out in real estate, you better manage your own property, because you need to understand exactly what's going on and how to make it work. You can, okay, so you would know better because I don't manage for anyone else. But if it's 2 or more, you have to have your real estate license. You know, is he, how many units? 600, you said? Oh, okay, close enough. You're collecting rent. If you were taking rent from a tenant, basically. Yeah, a maintenance guy, it's different. You don't need to have your real estate license. Good. I'm glad you came. I don't see you that often now. All right, so moving on to your net operating income. Obviously, that's going to dictate the property value. Well, it combines with cap rate to find that property value. Replacement reserves. So this is like your CapEx. Asset management fees. That's what's going to the syndication company to manage the asset. They're over the property management company. So before debt, cash flow. So that you're going to notice a big difference in the debt in year 1, 2, and 3. Any guesses? Bingo. It's interest only. So again, we're taking on a slightly distressed property. We want to make the cash flow as high as we can so that the investors can get their distributions. So if we take interest only, you got principal and interest only, we can pay this lower payment instead of the higher payment, so the cash flow looks a little bit stronger. So as we're taking those 2 to 3 years to implement that business plan, we can do that now. So you see the cash flow here ain't that pretty because there's a lot of stuff going on with the property. We start to implement that fix. By year 3, we've got it really figured out. So when the principal kicks in, we're good to go. Did you see it say interest only on there? No, I'm just kidding. So moving on, preferred return. So for you guys that are investing in passive syndications and you're wondering, well, you'll never get a guaranteed return. You'll never hear that. You're going to get the primary slot on your return. So that's what a preferred return is. You're preferred to get that return first. So as you can see on the screen, a preferred return gives the limited partner LP passive investor priority for cash flow distributions. So for example, let's say all the limited partners invest $3 million. They're going to get 8% of that annually. So the first $240,000 of cash flow from the property are going to go to the limited partners for that first that year, the first part of the cash flow. Does that make sense as far as what that preferred return gives you? You give me a weird face, Kurt. I don't know. Oh, geez. You said it, not me. You said it, not me. So now here's where the structure comes back into play. So that 8%, that 240,000 goes to the limited partners because they get their return first. And now whatever you're left with, let's say it's $300,000 of cash flow, you're left with $60,000 of cash flow for the year. 70% is going to go to those limited partners. The other 30% is going to go to the general partners. Again, we don't have capital in the deal from this standpoint. So why should we get to collect so much versus these guys over here? And if we're invested with that as well, we're also going to get cash flow from the distributions. So now let's look at year 1, 2, 3 again, and where those cash flow, those distributions are going to look like. So again, this amount here, 308,000 of that's going to go to the limited partners, and then about 30,000 goes to the general partners. And you can see how that proceeds for each year where the cash flow goes. So again, we get the principal and interest off the debt. So now you're going to see those numbers are going to decline, but they're also going to increase because we've increased the property income. Does that all make sense for us there? Yep. Yes. So that's a little complex. So that's why I didn't want to mention it in this of what the catch up is, because the waterfall can get very confusing. I'm sure if you've looked at them, you're just like, yeah. And like I said, so a buddy of mine, he has about 1,400 units. He doesn't do a preferred return. He does a straight 70-30 split. The way he can do that is because he's not charged an acquisition or disposition. He does, but he also has investors that are putting in $500,000 each, which is great. So he can look at it at a better standpoint. So now we're going to look at the scenario with a refinance on the property. So year one is going to match year one of the last one, but now we're going to refinance the property. So let's say we have that $3 million. I'm going to stand back here again so I can see it with you guys. So let's say we have that $3 million invested. We do a refinance. That year two, that 5.3 million is taking into account the, let's say it's an 80% loan to value, whatever they're taking back out of that refinance, and the cash flow. So 2.3 million now gets distributed to the limited partners, or excuse me, that gets broken down, that 8% preferred return, the 30 and the 70 for the GPs. So 1.7 of that 2.3 goes to the limited partners, and then 600,000 and change goes to the general partners. So they now have a large chunk of their capital back from year one, year two with the refinance. Now you can look at year three, they're getting $500,000 as the limited partners, and then the general partners get a little bit over 100,000. Again, I'll email this out to you guys. I'll send it out so you can look at the numbers and kind of see what they're calculating there as far as the returns, and we'll get into the returns as a minute as well. How am I doing on time? Doing good. Yep. So now let's look at an affordable example. Well, Dante, I don't have $1 million or $3 million to invest. You don't, Rob? You don't have $1 million you want to invest with us? Okay. So now let's look at a more reasonable. I have $25,000 to invest. Let's see what that looks like. Year zero, we're investing $25,000. So therefore you're not going to see it. You're seeing it go negative because it's going into the asset, into the investment. Year one, cash flow is a little rocky. Let's say you get 1,000 of that back. Year two, 1,900. Year three, we've implemented the business plan fully. You're seeing 14,000 of that back, the refinance. Year four, 2,000. And then year five, that's sales proceeds plus the cash flow. So now you're looking at an 18% annual return on your investment, the growth, and a 1.9 equity multiple. So like I said, you brought in 25,000, you're taking out the 31,000 plus a portion that you're getting back from your refinance. So what that's showing you for this, your cash on cash returns, what you're getting annually, what that's going to bring out for your compound interest for the 18 years. So you've just about doubled your money. So you put in 25,000 in year one, technically with the investment. And then in year five, you're getting just shy of 50,000 back. So you've just about 2x that investment. So that's what an affordable standpoint looks like. Not to mention, which I don't have in this presentation. Yep, I'll get to you in a second. I'm going to go over that another time. At the end of each year, you get what's called a K-1 document. It's like a glorified 1099 for investing. You get a portion of these tax benefits because you're owning a percentage of this real estate. The depreciation, the massive cost segregation that happens in year one, and anything else that's written off on the property, you get a portion of that. Yes. Like I said, it's from 10 to 20. So that's going to be on the higher end. In this scenario, it just shows 18%, but it can be a little bit lower. So once you get to that, you're getting to that 20%, again, higher risk, higher reward, or you got an operator that's just not being conservative on the underwriting numbers. Right. And I'd like to see the tax returns on your stock trading and your capital gains bill. So again, you're giving up like maybe a 5% return from buying a duplex in Syracuse. You're also not dealing with Syracuse tenants. Not all of them are bad. You're not owning the property directly. You're not taking on the liability, and you're spending much more time with your family. If you love your day job, you're doing that as well.
For your 2,200 units, are you looking specifically in Central New York?
So we do look at Central New York as a whole a little bit because Amazon's coming in, more jobs are coming in, more building, more construction. We're actually seeing the numbers do this a little bit. Schmidt, you can attest to the housing market. That's going up too. Property values are increasing. That's also a supply issue. Hot markets right now, you're hearing about the Charlotte, the Dallas, the Fort Worth. You know, we're looking in those markets. So we've done research in Greensville, Winston-Salem as well, of markets we're looking to get out.
When I heard you earlier say you're trying to take like property management on board, I didn't know if
we'd have to be really, really congested in a market. We'd have to have, 3 properties in a 5-mile radius to make it work. So that won't be for. Correct. Yep. More of the Southeast, but if we do want to onboard property management, it'll probably be a 5-10 year timeline until that even happens. In a perfect world, it'd be nice to have right up front. So just real quick, kind of take a look at what the stock market did. It dropped by 25% in March. Real estate did not drop like that. Obviously, you cannot experience that hit unless you sold. I had a buddy who lost $500,000 in March. He didn't really lose anything because he didn't take the recognized loss on that. He didn't sell. He held on to it. Apartment buildings were the least affected when it came to the 2008 downturn. So if you do a little bit of research in your own time and look at the facts, apartments held the best next to self-storage as well. What some of you guys may have not known is a self-directed IRA. So you can invest passively in real estate and a syndication through your self-directed IRA, through your IRA. If you're sitting in here and you have a 401k and you leave that job, or maybe you want to invest in real estate and you basically hit the off button on your 401k, that's going to get automatically turned into an IRA depending on how that plan is. And for as little as about $50, depending on your custodian, which is who manages that self-directed IRA for you or is the middleman, so to speak, you can invest passively into real estate and get those returns. So those of you that are sitting in here and say, oh, I have a $100,000 retirement account and I'm getting 6 or 7% in the stock market, that's great, but you can invest it in real estate and maybe get 10 to 12% overall. It's going to work just like an IRA though. Obviously this isn't based on the IRA, but you still can't touch it till 59.5 if it's a Roth IRA. Those cash flow distributions go to the account and then you get to touch them tax-free if that's the IRA account you have set up. I believe it's episode 25 on my podcast. I have a custodian from the vice president of American IRA come on and talk to people about how this works and how beneficial it is. You know, a lot of people say, I can't invest in this. And then they find this out and they say, oh my gosh, I can invest in that. I'm getting way better returns. So that's with the self-directed. Tom. Yep, you still get the tax advantages. So everything's going to flow right through. The way I like to look at the self-directed IRA is, and no offense to anyone here who does retirement accounts or anything, you basically have a financial planner, a retirement specialist that's managing your money for you. They're taking fees off of the top. They're in control of where your investments go. The self-directed IRA, you're in control of where your own investment goes, and you're not getting any fees on top of that. You're getting like a $50 fee and maybe a $150 fee per transaction of where you're moving money around. In the grand scheme of things, that's not that much money. Exactly. Yeah. No. So does Kurt? You can do it personally. So it goes through the custodian. The custodian is basically who's actually getting those distribution checks and everything, and they have their own account set up with them. So there's no entity structure or anything. As well as your individual, let's say you have 5 buddies, you all want to put in $20,000, so you have 100,000 you want to invest in a syndication. You can invest through an entity as well. So Dante Belmonte LLC can invest in Victory Capital Group's syndication. I don't have to invest myself. The rules as far as accredited and sophisticated are a little bit different when it comes to an entity, but it's fairly similar.